We are diving into variable life insurance for the national portion of the life insurance exam. Variable life is a permanent insurance product that blends traditional death protection with the flexibility of investing cash values into a separate account. This separate account is a fundamental concept for the exam because it is legally and operationally distinct from the insurance company's general account. In a traditional whole life policy, the insurer places premiums in the general account and guarantees a minimum interest rate, meaning the insurer bears the investment risk. In contrast, variable life insurance places the cash value into various investment subaccounts, such as equity funds, bond funds, and money market accounts. The most important point for the exam is that the policy owner, not the insurance company, bears all the investment risk. If the subaccounts perform poorly, the cash value can decrease, and there is no guaranteed minimum cash value. However, the exam will often ask about the death benefit. In a variable life policy, there is typically a guaranteed minimum death benefit provided the premiums are paid, but this benefit can increase if the underlying investments perform well. This dual nature of being both an insurance product and a security leads to a specific licensing requirement that is frequently tested. To sell variable life, an agent must hold a valid state life insurance license and a federal securities registration, such as a Series 6 or Series 7. If an exam question asks what is required to sell a product where the value is based on a portfolio of stocks, always look for the answer that includes both insurance and securities credentials. To help you remember this, think of the phrase variable means variety and venture, because the policy owner has a variety of investment choices and takes on the venture or risk of the market. Another area where the exam tries to trick students is the distinction between variable life and variable universal life. While both involve separate accounts, variable life usually has a fixed, level premium, whereas variable universal life combines the investment features with the flexible premiums of universal life. If a question describes a policy with a fixed premium and cash values that fluctuate with the stock market, they are specifically talking about variable life. You should also be prepared for questions regarding the prospectus. Because variable products are considered securities, federal law requires that a prospectus be delivered to the applicant either before or at the time of the sales presentation. A common trap is a question suggesting that the prospectus can be delivered at the time of policy delivery, which is incorrect. It must be at the point of sale. Regulators also play a part in exam questions. Variable life is duly regulated by the State Department of Insurance and the Federal Securities and Exchange Commission. When you see the word separate account on your test, your mind should immediately go to variable products and the transfer of risk from the insurer to the insured. The exam might also ask about the voting rights of policy owners. In variable products, policy owners have the right to vote on matters affecting the separate account, similar to how shareholders vote in a corporation. This is another indicator that the product is a security. Remember that the primary purpose of variable life is to provide a hedge against inflation by allowing the cash value and death benefit to potentially grow faster than a fixed rate, but this comes at the cost of guaranteed values. If you encounter a question asking about a product that provides no guarantee of cash value, variable life is your answer. Regarding the subaccounts, the exam might ask about the specific types of investments available. Policy owners can typically choose between aggressive growth funds, blue-chip stock funds, long-term bond funds, and very safe money market accounts. The performance of these specific choices directly determines the account value. The valuation of the separate account is calculated daily, while the death benefit is usually calculated annually, though this can vary by contract. Be careful with wording around guarantees. The only things typically guaranteed in a variable life policy are the minimum death benefit and the right to exchange the policy for a permanent fixed benefit policy within the first 2 years, a provision required by many states. If an exam question asks about the investment risk, the answer is the insured or policy owner. If it asks about inflation protection, variable life is the most likely candidate among permanent policies.